Welcome to the So What from BCG, the podcast that explores the big ideas shaping business, the economy, and society. I'm Georgie Frost. In this episode, not all growth is good. How can companies choose the right strategy for sustainable success? With me today is Justin Manley, who leads growth and innovation for BCG globally. Justin, what's your So What?
If you look over 10-year periods of time, growth creates almost 2/3 of shareholder value for any business, regardless of industry, regardless of where you are in the world. But it's hard. Only 40% of companies are able to create value accretive growth, and only 10% of companies are able to do so consistently over time. But it's possible. If you understand your starting point, you can increase your odds to being one of those 1 in 10 companies that consistently grow over time.
Growth is essential for business, but it's not a one-size-fits-all strategy. Some companies double down on their core, others expand into adjacent markets, and some take bold bets on new frontiers. But what if the secret to successful growth isn't just about the industry you're in, but where you start from?
So growth, as we define it, is simple. It's revenue growth. There are a couple of things that revenue growth can do for a company. One that we all focus on is value creation in the public markets or for private entities. And growth, more than any other factor, whether it be margin or multiple, drives shareholder returns. And so growth can create value. There's also a number of non-financial benefits to growth. Companies that grow tend to have more resilient cultures. They tend to have more opportunity. They tend to recruit stronger talent. And so growth is so imperative for companies, not just to create value, but to create strong cultures and exciting places to work. It's important to note that not all growth is good. Some growth actually destroys value. And when we look at growers, 1/3 of those who grow do so in a value dilutive way. And why is that? Sometimes it can be moving into lower margin spaces. Sometimes it could be moving into categories or adjacencies that investors don't reward as being defensible over long periods of time.
Could you give me an example of that, Justin?
Probably an example we all know, AOL Time Warner. So you saw tremendous revenue growth in that combination, but the merger itself destroyed a ton of value amidst culture clashes, different ways of managing the business. Another example of bad growth is when a high growth business model hits a wall. So recent examples of that, PayPal, they were experiencing tremendous growth, but there was a recognition that that could not go on forever, and it wasn't rewarded by shareholders and eventually impacted their share prices. Even more recently, bad growth can be driven by an industry upcycle that turns down. All of us probably remember the valuation run-up of Zoom at the start of COVID. That wasn't sustainable. That was created by a short-term phenomenon where the market has since leveled out.
Now, you've been looking at 2 decades of data on how businesses achieve exceptional growth and indeed why some fail. So just explain to us, if you would, what have you uncovered? Is there anything in there that actually really surprised you?
Yeah, there was. As we looked at those companies who've been able to really separate from the rest, and as I said, it's only 10% of companies are able to consistently beat their peers in growth. There's no one path. If you look at companies, some grow by M&A, some grow by geographic expansion, some grow by doubling down on their core, some grow by expanding to adjacent spaces. And all are viable paths to growth. And so as we looked at those who've been able to consistently grow over many years, we tried to deduce some patterns. And what we found was, and this is what I found the most interesting in this research, that your starting point determines more than any other factor the best path to growth. By starting point, I mean a couple of things. Are you in a high growth or low growth industry? Are you floating a rising tide or are you receding with an ebbing tide? The second most important factor to starting point is, what's your share trajectory look like? Are you gaining share against your competitors or are you losing share? And then we also found 1 or 2 other factors that mattered a lot. If you are losing share, are you losing that to a bunch of smaller players or are you losing to a market leader? And if you are gaining share, are you doing so in a way that's creating shareholder value or destroying it? And if you look at those factors, you're able to deduce and create a predictive roadmap for the paths to growth that will most likely create value and success over long periods of time for a business.
It would be obvious, I imagine most companies want growth. So there's not a lack of ambition that's the problem here. So what were some of the trends when it came to common mistakes that businesses make when trying to grow? And naturally, how do you then avoid those?
Common mistake is not recognizing the starting point that you're in and the criticality of that starting point. And I'll take the film industry a while back in the early 2000s as a story that most will know. And I'll use Fujifilm and Kodak as an example. In the early 2000s, it didn't take a rocket scientist to recognize that traditional print of photographs and film to drive that printing was changing. You had the two major players in that space, Fuji and Kodak, had to grapple with that change, and they each pursued very different choices in how they did so. Kodak, they doubled down on traditional film and print. Fujifilm, on the other hand, looked at their core capabilities and they said, where can we pivot? And they pivoted into adjacencies like medical imaging and diagnostic film, and they even pushed into new frontiers. And so you take those two companies, Fujifilm had a stellar run by recognizing in the early 2000s that they needed to change their model, and they did so. And so that is really the pitfall that I see in growth, is not recognizing your starting point and not acting appropriately in your growth path as you do.
Correct me if I'm wrong, but I imagine that sort of pivot requires quite a lot of real foresight and thinking, and is probably not the most common ways in which companies can really turn around. Or am I wrong there? And how do you identify where you can then move the company for growth, for new opportunities?
Yeah, it does take some foresight. It does take some real understanding of what's going on inside your business, what you're good at, and what's going on outside your business, and where your tide may take you, to use my reference before. But it's not just about, the Fuji and the Kodaks of the world, which were in very challenged places at the time. This also applies to companies that are in really strong positions. If you take companies in high growth industries with really strong share gain positions, what we've seen there is recognizing that you're in a great spot. The best path to growth is actually doubling down on the spot you're in. And if I take an example on that one, Visa in the last many years has had a real tear by recognizing they've got a great business, they're in a good spot, and what did they do? They doubled down on that business. They doubled down on their core. They expanded it. They invested aggressively into marketing. They expanded their core into new markets and geographies, and they invested to improve customer experience. And they were rewarded in that pursuit by having a 13% revenue growth over a very long period. And that was 5 points higher than their industry. So, if you contrast that with the Kodak and Fuji example, very different place, very different starting points. And the prescription for growth on those two kind of opposite ends of the playing field was very different.
It's interesting, isn't it? Is there common myth that being in a high growth industry guarantees success? But that isn't always the case, is it?
It's not always the case. And I have conversations with many CEOs in great starting positions, high growth, growing share. And often you hear an excitement and a desire to push into totally new businesses. Let strength beget strength in a new space. That can be a real challenge. And the shiny objects and the excitement of expanding to new categories or new businesses that are adjacent or further away from a really strong core can be a pitfall. And so as I talk to companies, just keeping a steely-eyed look at where are we, what are we good at, where's our industry going, and what's the nature of competition around us informs how do we think about growth.
So what are you hearing? What are you telling leaders in slow growth industries about the way that they should think about their growth strategies?
There can be a tremendous amount of value to be created in slow growth industries. And let me take an example again. If you look at Marriott, from the period of time between 2007 and 2019, they were declining sales in an industry threatened by disruptive newcomers. That was a really challenging advent in that industry for some of the legacy players. Now, what Marriott did that was different than some of their competitors is they reinvented themselves. They expanded geographically. They changed their business model to an asset-light model and sold off properties and entered into management and franchising agreements. And they shifted to that adjacent space. They leaned into that new dynamic in the market by creating a home and villa offering with personalized customer experiences. And so, again, an example of a company sitting in a space in the market that was being challenged, that was dynamically changing. They head into that change and they created quite a bit of value over the years. And that enabled them to be a real consistent and breakout grower in the market.
So you've identified 6 distinct growth archetypes. Just explain what they are, how they differ, and how companies can use this framework to make smarter decisions about growth.
Sure. So if I describe a 2x2, which consultants are known for using, that the 2 primary axes that determine starting point, one is industry growth. Is it high or low? And then 2 is share trajectory. Are you gaining share or are you losing share? Now, there are 2 variations within that 2x2. For those companies that are in a high growth industry, but they're losing share, it is predictive to best growth path if they're losing share to a big guy or to a bunch of small guys. The other variation in that 2x2 is on share trajectory. If you're in a low growth industry, but you're still growing share, the nature of that share gain matters a lot. Is it value creating share gain that translates to TSR growth above median, or is it value dilutive share gain, which translates to TSR growth below median? And that creates 6 archetypes, and we have created catchy names for each. So for instance, a high growth industry growing share, that's a star. You're in a great place. That was the Visa example I mentioned. On the other hand, if you're losing share in a slow growth industry, you're challenged. That's a tough place to be in. That's a Marriott example. But Marriott grew, and so did Visa. In each of those very different starting points, you can grow. And so I think that's an encouraging takeaway for any leader of an organization. No matter where you are, growth is possible.
I want to bring in external factors because we just have to look around. There's some disruption, shall we say, in the world. How much does that feed into growth plans? I imagine a lot of companies, we've certainly seen it over the last few years, perhaps just hunker down and perhaps growth comes off the agenda. Is that fair?
I think most successful companies never put growth to the side. Growth, as I mentioned at the outset, is the single biggest driver of total shareholder return. And over a 10-year period, growth represents 56% of a company's shareholder return. So strong companies with strong leaders always consider growth. And you see it in the way companies shape their annual plans. You see it in the way companies present their earnings reports. People talk about growth. Growth is exciting, it's rewarded, and it matters. Now, the question on all of the things going on in the world today is an important one. And while I've said that starting point matters, and it does, seeing where the world is going matters too, because starting points can change. An industry can be high growth and shift to low growth overnight in some cases, depending on geopolitics. And so as we advise companies, we bring not only our view on most likely paths to growth informed by research like this, but we also bring to bear where's the future going? Where's the world going? And how does all the activity, whether it be tariffs or conflicts or other aspects of geopolitical tensions, impact industry growth and a company's position within it?
So how do you build, assume you do, flexibility and resilience into your growth strategy and your business plans?
That's a great question. I think resilience is the more important word in your question for me. And the reason why is once you've chosen a growth path, having conviction and sticking to it matters. Companies that are halfway into their growth plans rarely make them materialize. So commitment and resiliency in the face of changing dynamics over long periods of time matters. Letting 1 year's stock performance change your well thought out growth strategies is fraught with risk. So as I talk to companies, putting a lot of work into the right path for growth and executing with conviction and resilience matters.
So those are big external pressures going on, but there's also always, I suppose, more internal pressures, short-term financial pressures. How do you balance that? How do companies get that right? Those short-term financial pressures with long-term growth ambitions?
Yeah, that's very tricky, to be honest. Any company I work with, almost every line leader is managed and bonused on their annual performance. And so it's hard to get away from the annual polls of shareholder calls and earnings targets, et cetera. But if you look at over the long term, what creates value more than anything else, and I'll beat this horse continually, it's growth. And so to pivot away from growth, and you see this all the time in companies, to do short-term cost cutting or things just to make the annual plan that take your eye off the ball from the long-term strategic ambition of the business can be fraught with risk.
I want to touch on one area that I think a lot of companies and governments are looking at quite closely as a lever to growth, and that is AI. Is it the panacea, shall I say, for growth? Is it the great lever that everybody hopes it might be?
I wouldn't say it's a panacea, but it will significantly impact the way companies think about their strategies and growth, and it already is. Let's go back to the Kodak and Fuji example. They were facing a revolution in how people used photographs and how people stored photographs and how people produced photographs. That dynamically reshaped their industry. I think AI will have the same impact on many industries. I don't have the crystal ball to exactly which ones and how they will be changed, but with the clients that I work with, AI is top of mind all the time. Where will it change my business? How will it change my business? How will it improve my advantage? How might it erode my advantage? And having a view on the impact to your business driven by AI, the impact to your industry driven by AI is paramount. I've done a lot of work myself in consumer packaged goods, and most innovations in consumer packaged goods are led by big branded players. They have the money, they have the scale, they have the margins to be able to push the envelope of innovation. AI is making innovation cheaper and faster. And so one of the potential risks for branded consumer players is that private label store brands are able to start to deliver similar levels of innovation to branded players by using AI-enhanced tools and able to innovate at lower prices, faster, and come close to the clip of innovation that their branded CPGs are able to deliver.
Do you have any general advice that you would give around this subject to leaders?
I think experimenting with AI and understanding what it can do for your business right now is table stakes. Any company, including any of the companies we highlight in our growth research as being consistent, steady growers over many years, they have a view on where AI applies to their business, where it doesn't, how it's going to change the nature of their industry, and what they're going to do about it. And so my advice to all companies would be do the same. Understand what AI might do to your industry, not just in the next year, but in the next 10. Understand where AI may enable you to improve your advantage, and understand where AI might threaten your advantage, and set up a plan that enables you to increase the positive impacts and decrease the negative ones.
We've had the so what, Justin. Now we have the now what. What are the next immediate practical steps that leaders can take?
I think first, understand your starting point. Understand where you are in your industry, against your competitors, how you're doing, what your special sauce is, and what can be the cornerstone for growth in your business. Using that, develop a path. Decide, does M&A play a big role or does it not? Is my core suited for long-term sustainable growth, or do I need to expand to an adjacent space? And by connecting your starting point to the menu of options for growth, using the research that we've done, you can develop a much higher chance of success for sustained growth over many years.
Justin, thank you so much. And to you for listening. We'd love to know your thoughts. To get in contact, leave us a message at thesowhat@bcg.com. And if you like this podcast, why not hit subscribe and leave a rating wherever you found us? It helps other people find us too. And if you'd like to check out the report that Justin was referring to, there is a link in the show notes of this episode.